Thank you, Chip. Okay, so it's a pleasure speaking with you today. We're going to go to the first slide. What is a coin? What is a token? And what's an NFT? So generally speaking, blockchain is like a sophisticated computer program that covers the entire Earth. So it is decentralized, so everyone has access to it. It's not like when you work with a company that they have their own database and they control who gains access to it. Blockchain is accessible to all. It's also immutable. You cannot delete anything. You can add, but not take away. So there is a public record of everything that happens on the blockchain. It's really a public distributed ledger. So it has, what comes in and what goes out. The blockchain can host smart contracts. Smart contracts are self-executing contracts. It means it doesn't need the intervention of humans to make things happen. So I'll give you an example. Let's say a farmer hires an insurance policy and they implement a smart contract pursuant to which, if it rains more than 4 inches, the farmer will get paid by an insurance company. So what happens is that they connect with a database, Oracle, for example, and when it rains more than 4 inches, the insurance company will automatically pay. So no one has to complete any form, process the payment, anything. It's all set in stone ahead of time. So generally speaking, you can create a coin, a token, an NFT. They are called digital assets. So a coin like Bitcoin is a digital currency and it's used for peer-to-peer transactions. So you don't need to go through a bank or financial institution. You can also change it to fiat at any time. Tokens and NFTs are different because they have functionality. So you can do more with them. It's kind of like an app. It's important to know that technically, they are both considered tokens and are regulated the same way. In both cases, you can attach an asset to a token. So for example, if you want to tokenize real estate or any asset, in the case of NFTs, you can tokenize a work of art. So you can attach real world assets to these digital assets. And also an important element is that they both allow you as a creator to control or design the flow of funds. So for example, if you're an artist and you sell an NFT, you have the ability to say, okay, as an artist, I will receive a royalty payment in future sales. Same thing with a token. You can treat them almost as shares. So you can give the owners benefits, including economic benefits. As for their differences, main differences between tokens and NFTs are that tokens are fungible, like money. You can have as many as you want. NFTs, as their name says, it's non-fungible. So if you issue an NFT, it's important to have a limited number of NFTs. And, they are unique. So you can do a series, but not too many, because then it loses its essence. They are sold in different marketplaces. So tokens are sold in exchanges and NFTs in marketplaces. One point about NFTs is that intellectual property is key because you can only sell what you own. And I'll get into that more later. Okay, so now we're going to go on to slide 2. And what's important to keep in mind when you decide to issue tokens to either launch a startup or create a new source of revenue for your existing company. Something important to think about is whether your token qualifies as a security or not, what people call utility. So the Securities Act of 1933, it addresses this point, and basically, if your token is an investment contract, it would be treated as a security. the practical consequence is that you would have to register that security with the SEC unless it fits within one of the exemptions. So how do you know if your token is an investment contract? You have someone investing money in a common enterprise. So think of in a company with a reasonable expectation of profit. So basically, if I invest money thinking that it will increase in value, that's an expectation of profit to be derived from the efforts of others. So basically, the value of the token is determined by the team that launched the company. I would say the most sensitive element of these four is the expectation of revenue. And sometimes there are companies that go out of their way to make sure that the token is not a security, but then a low-level employee at the company says, oh, invest and you'll be rich. And the SEC, it's a fact-based analysis, so they look at all the details. So it's really important to have a very thought-out plan for the company. Some guidelines in order to prevent your token from qualifying as a security is, the first one is try not to keep tokens for the founders. The second one is do not pay contractors or yourselves in tokens. Try to have people who will use the token be the ones who buy the token as opposed to just investors looking to make money. Generally speaking, you should not say or distribute to token holders revenues, like telling them if we sell more, you will receive more. That's an expectation of profit. Also, try to avoid a feature like burn feature to control supply and demand and the value of the token. That's not well regarded by the SEC. Also, try to avoid promising that you will list the token on an exchange, because that will be seen as trying to create a secondary market. Sometimes it happens that exchanges list the tokens without asking you, or third parties do so, and that's okay, but it's important for you not to make that effort. And the last one is that it's important that the tokens be issued once the platform is fully functional, as opposed to using the token to raise capital to develop the platform. Okay, let's go to slide 3. Here, I just list some sample token exchanges, the most popular ones. And how do you list a token on an exchange, a utility token? Well, first you complete their application form, which is simple, and then you need an opinion from a reputable law firm concluding that your token is not a security. Slide 4. If your token is a security and you really don't want to register with the SEC because it's very expensive and cumbersome, there are 4 main exemptions that you should be aware of. Regulation D is the one that most people use to fund the development of the platform. So under Regulation D, you can only sell tokens to accredited investors. These are high net worth individuals who have an annual income of over $200,000 or together with their spouse, $300,000, and or a net worth of more than $1 million. Also, banks, insurance companies, brokers, and trusts qualify. Even though the law doesn't require you to create a prospectus, which is the most expensive part of Regulation D, we strongly recommend that you have one to protect you from liability, because it's in the prospectus where you list all risks associated with the token. You have to file a Form D with the SEC, and then there's a 1-year holding period. So after that 1 year passes, you can transfer the token freely. Then there's Regulation A, which is called a mini IPO. There are 2 types. One allows you to raise 20 million, the other one 50 million during a 12-month period. It requires you to file a registration statement and offering materials with the SEC, and it does bring reporting obligations. So that's a much more formal path. Then we have Regulation S for people who want to launch their token outside of the US. And it's important that you don't have any directed selling efforts in the US, because if you inadvertently create a secondary market, they can hold it against you. So if you use Regulation S, it's important to work with either on your website or with exchanges that have geographic blockers so that US people cannot buy the token. After 1 year, they become freely transferable. So a lot of people who have tokens that qualify as tokens, they go through Reg S, hoping that in 1 year, it will be much easier to trade security tokens in the secondary market. That's the toughest challenge that we face today with security tokens. In utilities, if you go through one of these exchanges, you can really access the market. With securities in the US, there's a lot about alternative trading systems, which in essence is a broker dealer, but you cannot freely sell and buy tokens. The broker dealer has to find a buyer, in essence, do a one-on-one transaction. And the last one is crowdfunding, or Regulation CF, and allows for 5 million during any 12-month period. It's open to non-accredited investors. Usually you have to go through a crowdfunding platform like Seed Invest, Fundable, Circle Lab. You have to file a Form C, and there are certain transfer restrictions for 1 year. So basically you can transfer your token to the issuer, to accredited investors, to family members, for example, if you set up a trust. So again, what most people do these days is they use Reg D to finance the platform. They issue shares in exchange, not the tokens. And when the platform is ready, they issue the tokens. Okay, so let's move on to slide 5 about NFT and what's important to keep in mind when you issue NFTs. The key aspect is intellectual property. Not just to sell what you have, but also to define the rights. So you can do an assignment or a license where you grant certain rights to the holder of the NFT, but no ownership right. Or you can transfer entirely the rights. So whoever buys the NFT becomes the owner of the asset. It's important to have digital certificates of authenticity. So whoever buys your token knows that they are buying the real thing. And then keeping in mind tokenomics, well, you can design your token any way you want. And a limitation that the marketplace has right now is tracking sales in the secondary market. It's challenging. So if you have royalty payments that you want to be enforced for life, at this moment, we're very close to having a system that allows for it, but it's difficult right now. So it can be done, but manually, so it's a little more expensive. And then you have to ensure execution. So if you have an NFT that promises the holder that you're gonna send a work of art, it's important to be able to enforce that right in real life. So a critical piece for NFTs is the terms and conditions. Also the website disclosures. It's important to, especially with art, to make an effort to keep bad actors out, to make sure your platform complies with OFAC regulations. And for that, we usually include, some items people can check in the terms and conditions, and also disclaimers on the website. Okay, let's go to slide 6, where I just list some sample marketplaces. When you choose one, it's important to see what's your target market and try to go with one that's aligned with your product. Slide 7. So these are things that are good to think about for both tokens and NFTs. The first one is compliance. It's good to know that you will be subject to compliance in countries where the token holders are. What a lot of people do is just pick the most strict country. There are many crypto-friendly jurisdictions these days. You have Switzerland, you have Singapore, the Bahamas, BVI, Cayman, Estonia. And so it's important to pick one to host the project for the company that will issue the tokens. Definitely you need compliance at that level. And then what a lot of people do is just to pick the most strict jurisdiction. And if you comply with that one, chances are you will be in compliance with the others. It all depends, of course, on your budget. Also, it's important to get the proper licenses in those countries. So for example, if you are in DeFi and you want to offer a banking product, like a loan or something along those lines, it's important to get the proper licenses in each country. Also, well, to think about taxes, usually it's treated as property, at least in the US, and you will be taxed when you either sell, trade, or dispose of cryptocurrency in any way and recognize a gain. The last element common for both is community. It's very important to create a community that will include your target market, experts, enthusiasts. Some people hire influencers and announce the issuance ahead of time via Twitter, Telegram, Reddit, Discord, Steemit, any social media platform will do. Let's go to slide 8. So at the very beginning, we had blockchain as an independent world, and then we had the legacy world. Today, legacy absorbed blockchain, and as a result, it's highly regulated. So the industry is being watched by 6 government regulatory entities. So the first one is Financial Crimes Enforcement Network, the Office of Foreign Asset Control, that's about sanctions, Office of the Comptroller of the Currency, Securities and Exchange Commissions, Commodity Futures Trading Commission, and Internal Revenue Service. So last Friday, the White House enacted a framework not to enact new laws, but trying to reconcile the ones that exist and try to promote borderless transactions that are efficient from a climate standpoint and security, of course. So an important aspect, let's move on to slide 9, because I want to talk about process before we open the questions. The first step is to create a white paper. That white paper becomes like the blueprint of your project. That's where you define your goals, summarize the business plan, list the functionality to be embedded into the tokens, address compliance, and corporate governance. Usually these teams are cross-border. You have people from many countries, so it's important to put the relationship among them in black and white. The second step we work on is on structuring and tax planning to make sure that you optimize flow of funds and minimize ongoing maintenance costs. Then you can create a compliance blueprint where you have the plan that you will execute, and then comes the execution. That's when you raise funds, you sign contracts with developers and other service providers, you file trademark applications, develop the terms and conditions, prepare the text for the website, come up with the guidelines for the PR, you sign the contracts with all stakeholders, and then if you want to implement token incentive plans for employees, for example, you would do this at the execution phase, and then of course, launch the token. So I've covered everything, everything I know about how to use blockchain for your startup. So let me know if you have any questions, Chip, if you want to allow that.
Yeah, definitely. We do have a question that I'm going to share from Joseph that came in virtually. So Joseph's question is, I met some investors who said they have SEC connections to qualify you for the token program. They said they can get millions of dollars in tokens quickly and invest using debt financing. What is it about tokens that make them so liquid? What makes it better than traditional methods?
Okay. So I would be careful if someone sells connections with the SEC, because the SEC has existing doors and you can go through them. So for example, one of them is requesting a no action letter if you have doubts as to whether your token would qualify as a security. In some cases, very few. It's worthwhile contacting the SEC ahead of time. I would say, the main difference between tokens and shares is, first, tokens are interactive. They allow for engagement with the community. If they are utility, they are much easier to trade than security tokens, but it seems to me the person is referring to security tokens because it looks like he's talking about raising capital. I would say technically you just gain access to a different market because the securities market is really dominated by traditional players, whereas in the blockchain world, there are more entrepreneurs, people who usually don't have access to the securities world. They do have access to blockchain because it's so decentralized. So I would use it maybe in addition to, and it just gives you more flexibility. So thank you, Joseph, for your question.
Great. Thank you, Clara. We have another question. Came in from the chat virtually. We'll put that up. So this one came in from Maureen. Having some issues getting it shared, but I can read it. Since this field is ever evolving, what is the best way to scale a startup in this space while staying on top of the ever evolving regulations, i.e., where to find latest regulatory changes?
Okay, that's a good question because it is a fast evolving field. And the way we do it is we take a picture of the legal system at the moment when you want to launch your project. And you are only required to comply with what's valid as of that time. Sometimes if you work with a law firm, you can ask them, or you can try to do it yourself through Google to monitor changes in the legal environment. But in all honesty, you are expected to be reasonable in your effort. And as long as you comply with what's in place at the time you launch your business, that's good enough. Good enough is good enough. So how to scale your business? It depends on what the business is about, because if your platform allows for the issuance of a non-security token, that will allow you to scale exposure very easily. If your token is a Okay, so can you hear me, Tip? It looks like we lost signal.
Yes, you just came back.
Okay. So it seems to me that if you can issue a utility token, that will give you exposure very quickly, very fast. If it's a security token, you need a more detailed strategy to make sure that you comply with the law. But scaling in terms of exposure, social media, scaling in terms of size, it's not too different than a traditional company. Looking for distribution channels, strategic partnerships, and when you meet an investment bank or a law firm, you can gain access to local players and global players. So I would just attack all fronts. But thank you, Maureen. Okay, Chip, are there additional questions?
We currently don't have any additional questions in the chat virtually. Curious to see if there are any in person at the Cambridge Innovation Center. I know we have some people attending there as well. So I'll give a few seconds to see if anybody there has a question.
Perfect. No, to the extent new questions come up, feel free to reach out and I'm happy to answer them offline also.
Absolutely. This is just a separate, not a particular question related to crypto or the regulatory environment or anything, but Joseph was just curious in the chat, what is the best way for the people in the audience to reach you?
Okay, best way would be my cell phone, which is 917-692-7886, or by email. It's C as in Charlie, K as in Kilo, R as in Rose, I, V as in Victor, O-Y, at Brown Rudnick, so brown like the color brown, and then Rudnick, I think it's at the top, RUDNICK.com.
Perfect. And just for those who are tuned in virtually, I will be putting up the contact slide that Clara shared with us in just a second as well.
Okay, wonderful. Thank you very much and best of luck.